Welcome to the Mainsail Financial Group Podcast series, where we host industry experts and local professionals to share some expertise in their areas. Today we've got Taylor Olson. Taylor's a commercial real estate broker with Colliers International. Taylor's been in the commercial real estate business since 2012, and him and his team have done 117 transactions and almost 3 million square feet in rental space here in the past 12 months alone.
Yep.
So couldn't ask for a better resource to have available here today. Taylor, thanks for coming out.
Yeah, absolutely. Thanks for having me. I'm excited to be on the podcast. Never done a podcast, so.
Sure. Well, welcome. I think it's a perfect time to kind of expand a little bit on some of your knowledge as well. With the Seattle area kind of booming and the Eastside market over here going crazy with the tech companies.
Right.
I think it's a great time to have you on and kind of share a little bit more about what you're seeing ahead of us.
Yeah, certainly. So, I think some of the biggest things that I would say in terms of the commercial real estate world is just the kind of the merge or the lack of divide between the East Side and Seattle. You're seeing a ton of companies that are having offices set up on both sides of the water. You have light rail coming in a few years. It's really connecting both sides of the water, and I think the commercial real estate world is being seen as just the Puget Sound region as a whole, rather just East Side versus Seattle.
Really interesting. That's interesting to hear, because I know a lot of the big tech companies, with Amazon and Google and Facebook coming out this way.
Right.
I figured it may actually start to get tilted a little bit, but it doesn't sound like that's the case, huh?
Yeah, I don't think there's much of a tilt one way or the other. I think it's more of there's different types of employees on each side of the water.
Mm-hmm.
I think that the East Side has traditionally been viewed as an older employee set. There's more people with families. I think the average age is even like 8 to 10 years higher on the East Side than Seattle. So you have a lot younger of an employee base on the Seattle side of the water than you do on the East Side. And there's several reasons for that. I think schools on the East Side, public schools, are considered much better. There's a lot more. I guess people drive on the East Side more. It's a lot just more younger, more nightlife demographics in Seattle compared to the East Side. So there's a number of reasons for that, but I think that now to kind of capture both of those employee bases, you kind of got to have an office on each side of the water.
Interesting. So with this boom going on for the past 10 years now,
right?
Do you see any end to what's happening here?
If people keep asking that and keep the phrase that we keep hearing is the analogy of it being a baseball game, and we're in extra innings and they don't really know when that is going to end. Mm-hmm. And everyone has their own opinion on recession's coming, but I don't know if that will truly impact the office market. Right now, the East Side in particular, that's where my focus is, so I have a lot more information on that, but it's a sub 5% vacancy. So even if there is an uptick in vacancy that comes along with any recession, I don't know if that's really going to have a major impact on what the office rents are doing and making that, I guess, easier for tenants to go out and lease a space.
Sure. One of the things that we've kind of noticed as a trend is that it seems, obviously, with a lot of these larger companies, the big tech companies moving in,
right?
Some of the smaller firms are getting kind of squeezed out of some of these big office spaces. So are you seeing any trends there in terms of location or anything like that where they're heading?
Yeah, I think that is tough. You're right. I mean, the majority of the leasing over the past 12 months, even just with the announcement today, I don't know if you saw this in PSBJ, but Facebook leased all of the Spring District Block 24 space that was available. It's 200,000 square feet, and you keep hearing these Facebook leased this much, Amazon's coming in and leased 750,000 square feet of a new development, and Google took all of Kirkland Urban, and there's not a lot of movement with the smaller players. With no lack of product coming out of the ground, it's tough for any movement for those mid-sized or smaller sized companies. Mm-hmm. Kind of trends for those folks to combat that, I don't know. A lot of people are moving into areas that weren't as highly sought after. Sure. Totem Lake, just further out into Redmond, suburban Bellevue, but then you see the rates kind of reflecting that kind of surge in demand in those areas as well, and you're getting some record high rates in areas that previously hadn't achieved the rates that they're getting now.
Really? So you're seeing a lot of spillover into some of these kind of satellite areas too, it sounds like.
Right. I mean, there's just no new space coming in downtown. Downtown's 10 million square feet of inventory, downtown Bellevue that is. Mm-hmm. The last few projects that have come out of the ground are fully leased now. There's no new development in sight. The next cycle's probably for a building to come up out of the ground that, that Amazon isn't already leased.
Right.
Is probably a few years away. So yeah, there's a ton of spillover of companies that are going into areas that are considered maybe less attractive than downtown Bellevue, but they have to lease space somewhere. So there's a lot of push to the peripheral markets, suburban Bellevue, I-90, Totem Lake, as I said.
Mm-hmm. Okay. So if a small firm really wants to sink its roots here in the Bellevue market, are there any areas they should be looking at specifically? Is there anything they can do to maybe be more attractive to the folks leasing the space?
Yeah, I guess, to put on the landlord's hat, because I only represent tenants, so I'm kind of always negotiating against a landlord. What they find attractive is a longer term lease, less capital outlay at the start of that transaction. So if you can find a space that kind of has workable bones, or maybe you pay for your own tenant improvements, there's ways to make yourself look more attractive to other companies, because now when a smaller, say 5,000 square foot space becomes available in Bellevue, you have 3 to 4 different groups that are kind of positioning for that same space. So, if you can pay for your own TIs, or if you can commit to a longer term, that will put you at the front of the line. But really, I'd say you just have to be very proactive and ready to move quickly once that information is available to you, whether you're working with a brokerage team like us, or you have someone else representing you, or if you find that on your own. But you got to act quickly.
Sure.
and be ready to make decisions quickly to hop on a space when it does come available.
Yeah, I know when you helped us find this space, it was we had to act pretty dang quickly. We actually lost another space because of that.
So you know, right? You lived it. Spaces come online, and there's 2 or 3 people that are jumping at that space, and if you don't move quick, then it's gone. So that happens a lot now in this market, just such a landlord dominated market, that you really have to be, I guess, just even more so prepared than you would normally in an average market, I'd say.
Interesting. I know that residential isn't necessarily your area, but as we see, to your point earlier, we see these older families, higher incomes, all these great jobs coming to the east side.
Right.
Can you speak at all to the residential market and kind of what correlations or anything you're seeing there as well?
Yeah, I would say, I don't have great residential numbers, but there is a lot of impact on the commercial world because of the influx of people moving into this area. You kind of seen a rise of condos come back, where the people are starting to build those again, where they hadn't since kind of the mid 2000s. I think that there's been a lot of upzones in areas that typically hadn't had that before, just so that you can get higher buildings, more multifamily buildings, condo buildings, etc. And then you're just seeing record growth in the city. Seattle was the fastest growing city for 3-4 years in that 2014, 15, 16 time period, just because of the amount of jobs that were being created here from these bigger companies. And the other cities that were on that list weren't major cities like Seattle was. That's pretty rare that Seattle, as a big city as it is, was the fastest growing city in the country. Yeah,
for sure. Was a lot of that due to the tech industry with the Amazons growing so quickly? Or?
Yeah, it would. Amazon's hiring at a super high pace, and then you have tons of these Bay Area companies coming up here and setting up outposts, and then you also had a lot of organic growth from companies like Smartsheet and Apptio and Valve. So you had kind of a perfect storm of organically grown companies that are growing, and then also the influx from the Bay Area.
Yeah, sure. Interesting. I would imagine, especially as you look back to, 2016 there, the last, 4 or 5 years have probably been just awesome to be in the commercial real estate business. But what are some challenges you and your team are facing, as this market kind of maybe gets a little long in the tooth?
Yeah, I would say the biggest challenge is for us, just because what our team does, the commercial, real estate world is very vast, but our team's focus is just representing tenants. So over the past 3-4 years, it's really challenging to find space as you live through, right? So space is at a premium. So if you have a company that's 10,000 square feet, I do a survey now, and maybe there's 2 or 3 options. Whereas if I did this survey back 5 years ago, you had 8 or 9 options.
Sure.
So your leverage to negotiate goes down. Rates have climbed. We're seeing some tenants have their rate increase 40% on a renewal that we did 3 years ago. So I'd say that part is tough. Just the market has totally shifted. It is a landlord's market. So that is a challenge. I think the other challenge is just really being dialed into the market in terms of off-market opportunities, subleases, space that may be coming back to the market, and just trying to find the information there where you can really put that in front of your clients before it hits the market, so that no one else really has that information or is aware of those opportunities that are coming. And then another challenge I think that is not as talked about is the construction costs for build outs. That's why you're not seeing a lot of movement right now from, say, the average size to mid-sized tenant, whether that's 5,000 square feet to 10, 20,000 square feet, is because the cost to build out the space is so great that I'd say there's probably a 30-40% premium on cost from just 3 years ago on the same build out. You take for example, we did from warm shell, so that's pretty much just building. There's no ducting, no ceiling tiles, carpet, anything. Was about $70-$80 a square foot from warm shell, and then now I'd say that's $120-$140 a square foot. So there's a huge jump in these construction costs. So if you move, there's really a premium that either the landlord's gonna have to pay, and then in turn you'll be billed back through length of lease term, or you'll just have to come out of pocket. So I'd say the construction costs, and that's pretty much everywhere around the country, but specifically here in Seattle, just with how much activity there is, those have really gone up, which have kind of trickled down into the market for tenants.
Well, that ties into what you were talking about earlier, I'm assuming, right, with the TIs. So another way, again, that you had mentioned that smaller firms may look more attractive without taking those costs on, right?
Right, yeah, and there's a couple ways you can do that, whether you finance them and just CapEx them yourselves, or ideally you be creative and try to find a space that you can utilize a lot of what's already existing, and maybe you just do carpet paint, but you're not building out a whole new office and redesigning it. But I mean, that's a business need driver too. So if space doesn't lay out efficiently or doesn't work for your needs, then you can't do that, and you have to find some way to pay for those. Pay for the changes to the space.
Yeah. Expanding on that a little bit, you mentioned the TI costs, and then you had also mentioned extending the lease. Do you ever see anybody put more down, or is that part of the equation in any way, or is it really just those two variables?
Yeah, no. So the landlord, how they look at it is they're going to look at how long is the lease term. They're going to look at what rate they're getting and what they've underwrote the building at if they've recently acquired it. That basically they can do deals at this rate with this much concession in terms of free rent and tenant improvement allowance that they provide. And if it makes sense, it makes sense. If it doesn't, it doesn't. And at this moment in time, they have a couple groups that they can typically pick from for a vacant space to see if that works or not. But that kind of brings me into one of the biggest factors I think in the market is the world of co-working, and why that's so big now, because it's providing this flexibility to tenants that otherwise can't go to a direct space and do a lease for 10 years. Co-working is a good alternative to that, where you can come in and go to a WeWork, or you can go to an Extra Slice or a Regis, and there's probably dozens of providers.
Sure.
In the area, and you can find lease terms for month to month, a year, 18 months, 24 months, and
About that long, huh?
Yeah, absolutely. I mean, some of these providers are doing deals for the GEs, the Facebooks, the Amazons on 2-year deal, and they come in project based, 2 years, sublease from WeWork, and then take off after that, and WeWork has to find the next group to backfill.
Right, that's interesting, because I was thinking about that as I was getting ready for our conversation. Is it seems like a lot of people are either working from home or solo entrepreneurs working in a coffee shop or these WeWork spaces.
Right.
So I was thinking about how that how this market has gone so high, knowing that more and more people seem to not be working in a traditional office space too. So
yeah, I think that's just provided an alternative that allows for the single practitioner to go into WeWork, or it allows the 40-person team room for this technology company that just got a big contract from Microsoft, and they have 18 months, so they need to go find a space for 18 months. Yeah, it's 3% of the market in Seattle, and just under 2% of the market in Bellevue, co-working alone.
I don't know if this is necessarily your area, but I would have thought it would be higher actually already. Is that number growing pretty quickly?
Yeah, I think it is, and WeWork's taken down whole buildings and whole floors in several different markets, and there's new providers coming to the market all the time. So I think that will be something that continues to grow and develop in this market and really, around the country.
Interesting, yeah, and I mean, especially for a small business, I imagine, number one, it keeps your inventory or your overhead down.
Right, yep.
Quite a bit, but also your risk in terms of length of lease and stuff like that as well. You can control that a little better.
Right, no, absolutely. That's probably one of the biggest, challenges for companies today is like, hey, a technology company, they're going through funding rounds and trying to raise money. They don't know how many people they're going to have in 12 months, let alone 120 months. Like a law firm can come in and do a 5-year, 7-year, 10-year lease quite easily. A technology company, it's really hard to plan that far in advance. So those co-working options are something that allows them flexibility. You pay the premium on the space. But we've been able to negotiate with WeWork or we just some kind of flexible terms or maybe get a lower rate or some concessions for 18 or 24-month terms so that you can get that flexibility and then allow to kind of firm up your head count for beyond that term, and then